Good morning and welcome to Stoploss with Spencer. This is a beautiful visual aid. I know you're probably staring at this right now. You're not even listening to me. That's fine. I hope this will actually help you better understand what stop-loss insurance is by the end of this video. What are the two primary components of stop-loss, specific and aggregate? How do they work in conjunction? How could they potentially work separately? Why you want to purchase those? That will be covered. Very basic video. I don't expect you to be a certified self-funded specialist after this video, but this is an introduction to stop-loss insurance. Now, okay, let's take a step back. Why do you need stop-loss insurance? Well, stop-loss insurance is a type of insurance that self-funded employers purchase when they want to better manage their risk. So a self-funded employer is effectively saying, I am going to absorb the risk by being self-funded rather than being fully insured, paying an insurance carrier to indemnify you. You just give them premium, they cover all your claims. Self-funded employers say, I want to manage the risk. I'm going to accept the risk. And in doing so, what are some types of insurance that I can purchase in order to better manage, mitigate, and predict that risk? So that's where stop-loss insurance comes in. The two primary features or types of stop-loss insurance are specific and aggregate. Specific and aggregate can work in conjunction, can work on their own. You can have spec only, you can have ag only. The vast majority of employers outside of your true jumbo employers are going to most likely purchase specific and aggregate together. So specific insurance, this is the most important of the two because specific insurance is going to help you manage truly unpredictable and catastrophic risk. So specific meaning it is per individual, specific to the individual. In this example, I've got a $100,000 deductible that this self-funded employer would purchase. So they're saying, hey, Mr. Stop-Loss Carrier, I'm going to purchase a $100,000 specific deductible. Any claim by any individual that exceeds that $100,000 threshold, that is now going towards the specific stop-loss, and that stop-loss carrier will reimburse for any dollar above that threshold. So in this nice, again, beautiful, just artistic, wonderful graph that I've drawn, that $100,000 threshold has been breached by this one individual. They had a total of $125,000 claims. Now that can be medical only, that can be RX only, that can be a combination of the two, but that one individual during that policy period has exceeded that $100,000 threshold. So the employer is responsible for every dollar up into that $100,000 threshold. The stop-loss carrier then picks up the rest. So in this scenario, they don't only breach by $25,000, so that stop-loss carrier is going to reimburse the employer for $25,000. Theoretically, these contracts have unlimited maximums. So that could be a $20 million claim. Stop-loss carrier picks up every dollar above that $100,000 threshold. So this is the most unpredictable, but the most important of the two. This is also why about 80 to 85% of your premium is going towards this number as well, because the stop-loss insurer is trying to predict this, the wildly unpredictable individual catastrophic claim. So that's specific insurance, everything above that threshold. Aggregate insurance is the overall frequent claims, those daily, go to the doctor, maybe you had an ER visit, maybe I broke my arm, but it was only $5,000. All of these dollars underneath this $100,000 threshold start pooling towards something called the attachment point. Now I'll talk about an attachment point in a different video, but the way that a stop-loss carrier would calculate this aggregate number would say, hey, we predict your expected claims are going to be $1 million this year. Now we're going to add a buffer to that, typically 25%. So they add 25% on top of your expected claims and say, we will give you coverage if you were to exceed that, in that scenario, $1 million plus 25%, $1.25 million. So if all of these dollars accumulate at the end of the year, or the end of the policy period, accumulate and exceed that $1.25 million attachment point, or that aggregate threshold, then the stop-loss carrier will then reimburse you for all of the dollars above that. Specific, above that threshold, that's individual. Aggregate, below this threshold all pooled together. And if they exceed that reimbursement level, then that stop-loss carrier will reconcile that contract at the end of the year, just 3 to 6 months. They will reconcile that, and if you have still maintained a position above that attachment point, exceeding that aggregate threshold, then that stop-loss carrier will reimburse you for that. Now, this is really cheap. It's often called sleep insurance because it's really inexpensive. This is highly predictable to a stop-loss underwriter, and therefore the likelihood that this ever gets exceeded, really low. I've heard between 2 to 3% of the time, is there ever an aggregate claim on a stop-loss contract? Just on average, about 2% of the time, this will come into play. Underwriters, if they're doing their job, they're doing everything they can not to have an aggregate claim. Even if they do, usually rare. And then beyond that, typically those aggregate coverages are capped at about $1 million is kind of the default number. You can get more than that. Some of the BUCAs will give you unlimited. But realistically, this almost never comes into play, but it's so inexpensive that it makes sense for most employers to purchase. And therefore, I'm exchanging very small dollars to give myself a maximum liability, a worst case scenario. So specific stop loss per individual, aggregate stop loss under that threshold, pooled together. Those two types of coverage work in conjunction to mitigate the risk for a self-funded employer. I hope that made sense. About a 5-6 minute video so far. This is a crash course in stop-loss insurance. I don't expect you to understand everything after this. Hopefully I've stimulated some questions. This is just going to be the first in a series of many videos talking about all the ins and outs and provisions, enhancements, and strategies around stop-loss. But before we get into the really cool stuff, you got to know the basics. So thanks for watching. If you have any questions, let me know. See you next time.